Alright guys, today I'm going to teach you the importance of investing for the long term. Alright, so I'm just going to go over a few points as to how you can invest for the long term and also the general idea of it. So I'm just going to introduce this by saying, here we are at the year 1929, right? And we have the Dow 30. Now the Dow 30 is an index. The 30, not the biggest companies in America, but the 30 most well-known companies in America. And they're indexed, 30 companies indexed together to sort of mirror the entire stock market, just to see how it's doing as a whole. So if you were to put $84.19 into the Dow Jones in the year 1929 and you held it until 2010, you would have made $100,000. Now, if you would have sold out 2 years later for the short term, you obviously wouldn't have made that. But the point here is basically, if you're willing to hold for a long time, you can make serious money. Now, you're probably not going to make anywhere near this because, of course, the stock market's not like this anymore. But it's still, you can still make money. Now, the way the markets are set up today, you generally want to go invest in a stock for 1 to 5 years. No longer than that. I mean, you could push it and go for 6 or 7, but you can't really go for more than that. Now, back in the days of Warren Buffett, he would invest in a company, I don't know, 10, 15 years, I believe, and you can't necessarily do that nowadays due to how the market's set up. So, what we've got here, basically, the stock market will rise and it will fall. I'm sure you hear all the time about, a stock market crash is coming, a correction, overvalue. Maybe you've heard these terms tossed around every now and then. But basically, the stock market will rise and it will fall. It's going to have bad days and it's going to have good days. But in the long term, it's almost inevitable that you make money if you can hold into a stock for the long term. So in the short term, day to day, you have a 50% chance of making profit. Whereas if you invest for 10 years, right, over a 10-year time period, you have a 93% chance of making profit, which is almost entirely in your favor. So, obviously, we can even see now that long-term investing has a pretty good deal of advantages over short-term investing. And so, basically, when you're investing in the short term, you're sort of betting that a stock's going to do well. You don't know what could happen in the short term. Even if that stock's the most phenomenal stock on Wall Street, you still don't know what's going to happen in the short term. Something could happen, such as a scandal. I don't know, Apple could miss, iPhone production. They don't make enough iPhones in time. Something crazy like that, to where the stocks, shot down 15% in the next 3 months or what have you. And so you really can't predict how stock's going to do in 3, 6, and even sometimes, a year's time. So you're really safe investing, if you have to, a year, but I would suggest a year to 5 years. The longer, sometimes the better. So, you can pretty much predict how a stock's going to do in 3 to 5 years if you look at the company's fundamentals. Just like Warren Buffett says, billionaire investor Warren Buffett says, to look to the fundamentals. You can still do this. It still applies. You still look at the fundamentals if you want to pick a good company to invest in. So basically, you can see if a company is going to do well by looking at these key things. Okay, so ensure this when evaluating a company and you're thinking about investing in this company. So, is the company founder led? So, what that means basically is that the person who founded the company is the CEO. Now, the reason you want this is because the CEO, the founder who is also the CEO, is going to be a lot more passionate about the company and is therefore going to be a lot more adamant on seeing the company do well in the long term and is a company as a whole. So when the CEO is also the founder, you know, when the stock drops or something bad happens, you know, the company's failing, he's not going to run off into the sunset with all the money, liquidated shares, what have you. So he's going to stay there and ride it out because he loves the company. If you found a company, it's sort of difficult to understand from the perspective of somebody that may have never founded a company. But if you found some huge, you know, multi-billion-dollar corporation like Coca-Cola, and you see it from the times where it was nothing, where they're making maybe 20 liters of syrup a year or something, making, you know, $70 in revenues or whatever, and you see over, you know, 10 years, and then you see over time that company building and building and building until, you know, it's the multi-billion-dollar corporation it is today. So the CEO is going to be the CEO and also the who's the founder as well, is always going to be very passionate about that company. It's not going to be easy for him to run off when something happens, when, you know, hard times arise. So another thing you want to look at while looking at a company: does the company have more cash than it does debt? Now, why this is important is because if you see a company that has more debt than it does cash, well, it's sort of common sense. If they hit hard times and, you know, they need cash immediately, well, they're already in debt. They're going to have to borrow more debt, and therefore they're going to have to get more debt, and it risks, ultimately risks bankruptcy, right? So you definitely don't want to get into a corporation. Well, you don't always have to go into a corporation that has more cash than it does debt. You know, some corporations are big because they acquire companies, other companies, smaller companies like Amazon. That's considered a growth stock. Now, they're consistently acquiring companies, and so they spend all of their cash, and that's the reason why they have debt. They're still a huge company. You know, Amazon, they're huge, but they have debt because they're aggressively acquiring and trying to build the company. So, you know, a few years ago, I know Amazon got in a bunch of debt. People were complaining, and because they were acquiring smaller companies, you know, Whole Foods, I believe, was one of them, just right off the top of my head. But they kept acquiring companies and getting more and more debt. And I think maybe 3 years ago, they finally started making profit. So, I mean, but their revenues are phenomenal. But just it was 2 years ago until they actually managed to make some profit. So anyway, don't mean to rant or anything, but yeah. So basically, ensure that the company has good financials, right? More cash than it does debt. You also want to look for if the management is playing offense. What that means basically is that the management is, you can see it in their conference calls. So when you listen to a company's conference calls and you hear the CEO or the chief financial officer, if they're playing offense, when they're stating what has happened over the past quarter, when they're announcing, you know, the revenues, the earnings, the profits, whatever. When they're announcing these things, if they're playing offense, you're going to hear, not only are you going to hear, basically, if a CEO is not playing offense, or management, like CFO, COO, just the management in general, if they're not playing offense, they're going to be, they're going to state what their revenues were, their profits, and their earnings, and what they're going to say is basically, how they're going to maintain this growth, how they're going to, it's sort of like defensive. Like, think of American football. So they're playing defensive when they say something like, oh, we're going to do, we hope to maintain this growth. Whereas if a CEO and his management are playing offense, they're going to say, we made such and such revenues this past quarter. We're going to do this, this, and that to improve these revenues. We hope to consistently improve our earnings, or whatever. You can hear it within the tone of their voices, or their attitude, I would say, rather. So relatively low PE ratio. So this is the price to earnings ratio. Always want to make sure that the company has a low PE ratio. So just always make sure that you don't always have to make sure. It's just a good thing to have a low PE ratio, because a high PE ratio can mean a few things. So it can either mean that if it has a high PE ratio, going back to Amazon has a high PE ratio. It's somewhere in the hundreds or something. So that means people expect Amazon to consistently make more revenues than it did last quarter. So if a stock has really high PE ratio, that means that the investors expect the growth to continue and be higher in the future. So remember that. And you don't always need a low PE ratio in a company. It just depends on what you're looking for. So generally you want, when you're looking through the balance sheet of a company, so it's financial statements, you want to make sure that the profit margin is over 10%, the quarterly revenue growth is over 20%, and the quarterly earnings growth is usually over 20%. So these are just good indicators that the growth is still going within the company, and just shows you the company is still strong financially. And also when you go into websites that will show you the statistics for the specific stock and the ticker symbol, sort of like maybe Yahoo Finance or Market Watch or whatever, you'll see a graph by the side. Now what I like to do is I like to look at the graph, right? And I like to put on the option for 1 year and 5 year. There's also 3 months, 6 months, and I think there's all time. There's an all time, which means how the stock did the very first day the stock had its initial public offering. That doesn't matter. You want to do what you want to put it on the 1 year option and the 5 year option, right? And that will show you how the stock did 1 year for the past 1 year and the past 5 years, and it should have consistent growth, green growth, because as I told you, we're long-term investors here, so we want to see that growth consistently growing within 1 to 5 years.